Hi candidates, welcome to this session. And in today's class, I want us to discuss on this topic, which is one of the topics you should cover in this paper for advanced financial reporting and analysis, and also a very common topic in the exams. So in this topic, you're going to discuss on like four main issues or three main issues. Number one, you're going to define what is earnings per share. And number two, we are going to look on the significance or basically the benefit of this earnings per share to the shareholders of the company. And then number three, we're going to look on the various types of earnings per share, which companies are expected or basically required to compute by this particular standard here, which is International Accounting Standard number 33. So therefore, those are the three main issues we are going to discuss. And to start with, we need to define what is earnings per share. So when talk about the earnings per share or the EPS, popularly known as the EPS, this refers to the amount of earnings or basically the amount of profit which is attributable to each equity or ordinary share which has been issued by the company, So therefore, we can say earnings per share is the amount of profit or amount of earnings attributable to each equity or ordinary share issued by the company, a company. So that is the definition of earnings per share. It is the amount of profit or basically earnings which is attributable to each equity or ordinary share which has been issued by the company. Now, all the listed companies or basically those particular companies whose shares are trading in the securities exchange market, they're required to compute two types of earnings per share in accordance with the International Accounting Standard number 33. So, and the two types of earnings per share to be computed by those listed companies, we have something called the basic earnings per share, popularly abbreviated as BEPS. And number two, we have the diluted earnings per share, abbreviated as what? The DEPS. So therefore, we can say that IAS 33 requires listed companies to compute and disclose, two earnings per share or two types of earnings per share, two types of EPS, namely, number one, basic earnings per share, abbreviated as BEPS, and number two, we have the diluted earnings per share, abbreviated as DEPS. So therefore, these are the two types of earnings per share which the listed companies are required to compute and disclose by the International Accounting Standard number 33. It is important to note that when talk about the listed companies here, we are referring to those particular companies whose shares trade in the securities exchange market. For example, in Kenya, we are looking at companies like Safaricom, companies like maybe Equity Bank, KCB, Kenya Commercial Bank, and so on. All these companies are listed because their shares trade in the securities exchange market. And basically, we are saying that those particular companies are required under International Accounting Standard number 33 to compute and also disclose as part of their notes two types of earnings per share. And this particular earnings per share basically is important to the shareholders of the company because the shareholders can use that particular earnings per share in various ways. And therefore, in this case, we can look on some of the significance or basically some of the importances of earnings per share. Number one, we can say that it is used by the shareholders of the company to evaluate the profitability of the company, of a company, profitability of the company. So remember, in this case, we are saying earnings per share. It is basically amount of the profit or the amount of earnings generated by the company for each share which has been issued by the company. Therefore, this is like a profitability ratio, or basically it helps the shareholders to evaluate the profitability of the company. Number two is that this earnings per share is also used by the shareholders to evaluate, or basically we can say it's used by the shareholders of the company to compare. Let's talk about to compare the performance of the company in different years. It is used to compare performance of the company in different years. So mean that the shareholders of the company can use this earnings per share to compare the performance of company in different years. Number three, this earnings per share is also used to compare performance of different companies within the same industry, within same industry. Basically, what that means is that the shareholders of the company can use the earnings per share to compare performance of company A and company B if those two companies are within the same industry. And number four is that this particular earnings per share, we can say it is the basis. It is the basis of computing. It is the basis of computing a price earning ratio. Price earning ratio. So therefore, these are some of the significance or some of the importances of this earnings per share. And that's why we are saying all the listed companies is a requirement that they have to compute and disclose these two types of earnings per share, because they can be used by the shareholders in these various various ways. So then what I've said is that we're also going to discuss, or basically we're going to look on how we compute these two types of earnings per share. So let's start with the first one, which is the basic earnings per share, abbreviated as BEPS. So what is basic earnings per share? So this is the earnings per share which is computed by the company using the profit for the year, and also using the shares issued and fully paid at the end of the year. So therefore, we can say it is computed using profit for the year, and the number of ordinary shares issued at year end. So therefore, we compute this basic earnings per share using the profit for the year, and also the number of ordinary shares issued as at the end of the year. So how do we compute these basic earnings per share, BEPS? So this one is computed by taking something known as the PATOS. PATOS in full is the profit attributable to ordinary shareholders. We divide that with something called WANOS, weighted average number of ordinary shares. So that's basically how we compute the basic earnings per share. So how do we determine these two items? So let's start by looking on how we determine this one, which you have said in full is the profit attributable to ordinary shareholders, shareholders. And also it is important here you recall that when talk about the profit of the company here, the profit is the same with earnings. So meaning that in other terms, we can also refer to this as earnings, because the profit is the same with earnings. We can also refer to this as earnings attributable to ordinary shareholders. So in terms of how we compute this, we take the company's profit after tax. The company's profit after tax, in other terms, is also known as the net income. This is also known as the profit for the year. The profit for the year. So the examiner can give you any of these. So to this, we less two items. Number one, we less the preference dividends for the current year. Preference dividends for the current year. Preference dividends for the current year. And then if we happen to be computing the earnings per share, for a group of companies. To this, we also less a profit attributable to NCI, profit attributable to non-controlling interest, to NCI. So this basically how we get the profit attributable to ordinary shareholders. And basically that is one of the items which we need to have anytime we are computing the basic earnings per what? Per share. But as far as the computation of these PATOS is concerned, there are some points which are important for you to know here. And I think we have already mentioned some of them. Like here, when deducting or when computing these PATOS, we only deduct the preference dividends for the current financial year only. There are some instances whereby you may be told that in a given year, the company paid preference dividends for 2 years. So whenever you're computing these PATOS, to that profit for the year, you only less the preference dividends for the current what? Financial year. Number two is that when computing the earnings per share, actually both the basic earnings per share and also the diluted earnings per share, we use the profit for the year from the continuing operations only. So we can say a profit from discontinued operations. Actually, we can just put it like that. Discontinued operations is excluded from computation of BEPS. Profit from discontinued operation is excluded in the computation of basic earnings per share. So what is discontinued operations? Discontinued operations, these are those operations of the company which have been discontinued. A good example is a branch which has been closed down. It is a discontinued operation. Or when it comes to a group of companies and maybe the parent company has disposed one of the subsidiary, that is still a discontinued operation. So therefore, in this case, we are saying that when computing these earnings per share, both basic and also diluted, we only use the profit from continuing operations. Continuing operations, we are talking of branches which are still in operation and so on. But we don't, or actually we totally exclude any profit from any profit or loss from discontinued operations. That is very important because anytime you come across a question whereby the examiner is requiring you to compute diluted and also basic earnings per share, you may be given a profit for the year and you're told it includes a profit or a loss from discontinued operation. Make sure you exclude that loss or that profit from discontinued what? Operation. So that is one of the point which is basically important here as far as the computation of the PATOS, or as far as the computation of the profit attributable or the earnings attributable to ordinary shareholders is concerned. Number two, or there is still another point which is important here, that in case the preference shares issued by the company are redeemable, in case the company has issued redeemable preference shares, so the dividends for these shares here, they are not supposed to be deducted from this profit for the year. Why? Is because these particular redeemable preference shares, to the company, these are non-current liabilities. These are preference shares which have been issued by the company, and the company is supposed to redeem them. It's supposed to buy them back after a given period of time. And therefore, these preference shares, they're equivalent to debentures, they're equivalent to bonds. So that's why we are saying they are non-current liability. And therefore, the dividends for these preference shares are classified as part of the finance what? Cost. And basically, we know finance cost is an expense to the company. So meaning that in arriving at this profit for the year, this finance cost has already been deducted. And therefore, if we are told specifically the preference shares issued by the company are redeemable, don't less their dividends here because they have already been deducted in arriving at that particular profit as part of the finance what? Cost. And actually, this is one of the area whereby the examiner will try to catch you by giving you some preference shares, and also he tells you that they are redeemable. Most of the students will just go ahead and basically deduct those preference dividends there, which is totally wrong because they have already been deducted in arriving at that profit as part of the finance cost. So therefore, as far as the computation of the PATOS is concerned, the profit or the earnings attributable to ordinary shareholders is concerned, basically that's what you need to know. So then next, I want us to look on how we compute the other item here, that is 𝐻𝑜s. 𝐻𝑜s in full, we have said is what? Weighted average number of ordinary shares. It's also important to remember that the ordinary shares are also known as the equity shares. So how do we compute the weighted average number of ordinary shares, which we use in the computation of basic earnings per share? So this one is computed by taking the balance brought down, or basically by taking the number of ordinary shares, outstanding at the start of the year, So in this case, when we talk about the number of ordinary shares outstanding at the start of the year, here we are looking at, or basically we are referring to the ordinary shares which have been issued and fully paid at the end of the year. Number of ordinary shares issued and fully paid at the end of the year. And then to this, what we do is that we add the shares which were issued by the company during the current year. We add the shares issued by the company during the current year. And these shares issued by the company during the current year are broadly classified into two categories. Number one, we have those particular shares which are issued at full market price. And number two, we have those particular shares which are issued. We have talked about shares issued at full market price. And you have those particular shares which are issued at nil consideration. So when we talk about the shares which are issued at full market price, these are the shares which the company will issue in the course of the year, and they're issued at a price which is equivalent to their market price. The market price of the share is the price at which the shares of the company are trading in the securities exchange market. Now, those particular shares, for the purpose of computing the weighted average number of ordinary shares, these shares, we say that they are weighted. What does that mean? It means that these particular shares, for the purpose of computing the 𝐻𝑜s, they are always multiplied with the proportion of time they were held during that year. What does that mean? Let's assume that the financial year of the company starts on 1st of January and end on 31st of December, and you're told on 1st of July, which is basically 6 months to the end of the year, the company issued 2 million ordinary shares, and these shares were issued at full market price. So in this case, we are saying for the purpose of adding them here, we have to multiply them with the proportion of time they were held. So basically that means that those shares, we are not going to add them here as 2 million, but you're going to take 2 million, multiply them with the proportion of time they were held. We know that they were held 6 months out of 12. So that's how we deal with the shares which are issued at full market price. And then we have those particular shares which are issued at nil consideration. Nil is zero. It means that those are shares, or these are the shares which are issued by the company free of charge. And basically a good example of this is a bonus issue. Where the company will decide to issue additional shares to the existing shareholders of the company free of charge. Now, those particular shares, for the purpose of computing the weighted average number of ordinary shares, these shares, we don't weigh them on time basis. So meaning that these shares, even if they're issued, for example, like 2 months or 1 month to the end of the year, we don't multiply them with the proportion of time they were held during that year. So therefore, this is very, very important that those particular shares which are issued at full market price will always be multiplied with the proportion of time they were held. In that case, we say they are weighted on time basis. You have to remember that rule. And then those shares which are issued at nil consideration, they are not supposed to be weighted on time basis for the purpose of computing what? The 𝐻𝑜s. And then we add all these. Whatever you get here is what we refer as the 𝐻𝑜s, the weighted average number of ordinary shares, which then you are going to use here in computing the basic earnings per share. So therefore, that's what you need to note, that this is how we compute the basic earnings per share PATOS, all of our nodes. And basically, how do we determine the PATOS and how do we determine the one-offs? Now, next, I want us to discuss on how specifically we deal with the shares which are issued during the current year, because generally what we have said is that those shares which the company will issue in course of the year will make the shares which were outstanding, the shares which were issued and free paid at the start of the year to do what? To change. And therefore, next year, I want us to look on how specifically we treat or basically we deal with the shares which are issued by the company in course of the year, specifically in computing the weighted average number of ordinary shares. So here we can talk of causes of changes in number of ordinary shares, causes of changes in the number of ordinary shares. So when we talk about the causes of changes in the number of ordinary shares, here we are talking of some of the reasons why the number of ordinary shares which were issued and free paid at the start of the year will change. So basically that will change because there are some shares which were issued by the company during the current year. And actually we do have different types of issues which can be made by the company during the current year, which here we have talked about two categories, being the types of shares issued by the company during the current year being broadly classified into two. But here I want us to look on the specific types of issues which can be made by the company during the current year. And we can start with the issue at full market price. So when we talk about the issue at full market price or the issue of shares at full market price, these are the shares which the company will issue in course of the year, and these shares are issued at their market price. We have said that those particular shares, and that is something we have mentioned here, these shares are weighted on time basis. We can use W just to remember that they are weighted on time basis. Being weighted on time basis, we have said this means that those shares will always be multiplied with a proportion of time they were held. If they were issued 6 months to the end of the year, multiply them with 6/12. If they were issued 3 months to the end of the year, multiply them with what? 3/12. That's what you mean by the shares being weighted on time basis. Then number two, we have issue of partly paid shares. Partly paid shares. So when talk about the partly paid shares, these are those particular shares which will be issued equally by the company during the current year at full market price, but when the year is coming to an end, those shares will not be free paid. Like in this case, we can be told that on this date, that is on 1st July, the company issued 2 million ordinary shares at full market price, maybe of 40 bob or 40 bob. But when the year is coming to an end, assuming now the year is ending on 31st of December, so we are told that the only amount which has been paid per share is 20 shillings per share. 20 shillings per what? Per share. You can see these shares are not fully paid. Are not fully paid because the shares were issued at 40 bob, the shareholders have only paid 20. So in this case, when computing the weighted average number of ordinary shares, we only use the shares which are fully paid. We only use the shares which are fully paid. And therefore, in such a case, what you do, compute shares which are fully paid. So in this case, to compute the shares which are fully paid, this is quite simple. What you do, you compute the amount received by the company at the end of the year, and then divide that with the issue price. So like in our case here, using this small illustration, whereby the company had issued 2 million ordinary shares at a price of 40, and at the end of the year, that is on 31st of July, how much amount has been paid per share? 20 bob. So the amount the company has received at the end of the year will be equal to the shares issued 2 million times the amount paid as at the end of the year, 20. And then we divide that with what? With the issue price. The shares were issued at 40. So this will give us the shares now which were fully paid at the end of the year. And because also these shares were issued at full market price, we have now to remember our rule, our basic rule here, that shares which are issued by the company during the current year at full market price they must be weighted on time basis. So basically, because these shares were issued 6 months to the end of the year, so what we do, we multiply them with the proportion of time they were held, that is 6 out of 12. That's basically how we deal with the shares which are issued by the company during the current financial year. And at the end of the year, the shares are partly paid. So next, let's look on how we deal with the other type of the issue, number 3. And number 3, we can talk over the bonus issue. Bonus issue. What is a bonus issue? A bonus issue, this is the issue of additional shares to the existing shareholders of the company free of charge. Or in other terms, here shares are issued to the existing shareholders of the company at nil consideration. There is something which you have mentioned, that these particular shares are not weighted on time basis. They are not multiplied with the proportion of time they were held. So therefore, number 1, we can say that these shares are not weighted on time basis. Weighted on time basis. They are not weighted on time basis, meaning that they are not multiplied with the proportion of time they were held during that year. Let's assume that you're given information about maybe the year 2023, and we assume the year started on 1st January, ended on 31st of December 2023, and you're told on 1st of July, the company made a bonus issue of maybe like 5 million ordinary shares. So in this case, we are saying for the purpose of computing the weighted average number of ordinary shares, so these shares should not be multiplied with the proportion of time. Basically, what that means is that we should take, number 1, the number of ordinary shares which were issued and fully paid at the start of the year, and then to this we add the bonus element. Always we should have the date here. The year started 1st of January 2023, and then on 1st July 2023, the company made a bonus issue of how many shares? 5 million. So we are saying these shares don't weigh them on time basis. Don't multiply them with the proportion of time they were held. Number 2 is that in the event you are given information about the previous financial year, for example, we are given information for the year 2022. In this case, we also assume that these particular shares, or actually we assume these shares were issued at the start of the earlier reported period. So in this case, when we talk about the earlier reported period, we are talking of the start of 2022. And what is the implication of that assumption? The implication of that assumption, number 1, is that during the year 2023, we are saying those shares don't weigh them on time basis, because we will assume from the start, they were issued from the start. That's why we are not multiplying them with a proportion of time. They were held for the whole year. Number 2, you also use these particular shares to restate the earnings per share of the previous year, because when the earnings per share for this year was being computed, these shares were not used. But in this case, we are saying, we assume they were outstanding. They had been issued from the start of 2022. So therefore, what we also do is that we use them to restate the earnings per share for 2022. So we can also say bonus shares are also used to do what? To restate. Or in other terms, to adjust basic earnings per share of the previous year. So how do we restate that basic earnings per share for the previous year? So to compute the restated earnings per share for the previous year, which now will be the year 2022. So we take the PATOS, the profit attributable to ordinary shareholders for 2022. We divide that with one-offs for 2022. And then to this one-offs, we add the bonus shares, which were issued in the year 2023. This is basically how we compute the adjusted or restated earnings per share for the previous financial year. Anytime we have some bonus shares which were issued during the current financial year. So let's proceed and look on the other reason why the number of shares issued during the current year may change. And number 4 here, we can look on something called a share split. A share split. So what do you mean by a share split? A share split basically is where the company will subdivide one share into 2 or more shares. So, for example, in this case, you can be told that the directors of the company have resolved to split one share into 4 shares. So the effect of that is that as a shareholder of this company, if you held 1 share before the split, then after the split, you'll be holding how many shares? 4 shares. And therefore, here we can say that as a shareholder of this company, you have been issued with 3 additional shares. You have been issued with 3 additional shares free of charge. Free of what? Of charge. And actually, we can refer to these additional shares which are going to be issued with as a result of the split as bonus shares. As bonus what? Shares. So therefore, a share split is basically whereby the company or the board of directors of a company will make a decision to split one share into 2 or more shares, basically of a lower par value. And actually, we are saying the effect of that is that as a shareholder of this company, you'll be holding more shares after the split, or in other terms, you'll be issued with additional shares as a result of the share split, which you don't pay for. And therefore, these additional shares which will be issued by the company as a result of the share split, they are treated as an equivalent of bonus shares. They are treated as an equivalent of bonus shares. Being treated as an equivalent of bonus shares means, number 1, is that when computing the basic earnings per share for the current financial year, we don't weigh them on time basis. And here we are talking of the additional shares issued as a result of split. We don't weigh them on time basis. Number 2, if you're also given the information about the previous financial year, you use those bonus shares, those additional shares which are issued by the company as a result of the split free of charge, to restate the earnings per share for the previous year. So therefore, in case you come across this transaction, you just need to determine how many additional shares were issued by the company as a result of the share split. And in this case, we are saying treat those shares as an equivalent of the bonus shares. So then number 5, we have the shares issued as a result of a conversion, as a result of conversion of convertible securities. So shares issued as a result of conversion of convertible securities. So when we talk about the convertible securities here, we are talking of securities such as the convertible debentures, convertible bonds, convertible own stock, any security issued or any financial instrument issued by the company which is convertible in nature. And actually, the reason why you refer to these securities as convertible is because they give their holders an option to convert them into ordinary shares. And once the holders of such convertible securities exercise their conversion option, then they convert those convertible securities into what? Ordinary shares of the company. And those ordinary shares of the company, or those ordinary shares which will be issued by the company on conversion, they are also treated as an equivalent of the shares issued at full market price. Basically, what that means is that for the purpose of computing the one-offs, we have to weigh them on time basis. We have to weigh them on time what? Basis. So in this case, we can say shares issued as a result of a conversion of convertible securities are treated as an equivalent of shares issued at full market price. Being treated as shares issued at full market price, it means that for the purpose of computing one-offs, we always have to multiply them with the proportion of time they were what? They were held during that year. They were held during that year. So next, that is number 6. Let's look on the other reason why the shares issued at the start of the year may change. And number 6, we have shares issued as a payment of purchase consideration, as a payment of purchase consideration. So when talk about the shares issued as a payment of purchase consideration, this whereby the parent company will issue some ordinary shares to pay a purchase consideration. There is something we refer to as a share-based payment. Share-based payment is whereby a company, for example, can acquire a subsidiary, or a parent company can acquire controlling interest in a subsidiary, and the parent company decide to pay the shares acquired through by issuing its own shares. Alternatively, a company can buy some goods, or a company can be provided some services, and the company agree with the supplier of those goods or services that the company will have to pay for them, for those goods or services, by issuing its own what? Shares. So therefore, anytime the company has issued shares to pay the purchase consideration, the shares which have been issued equally are treated as an equivalent of the shares issued at full market price, meaning that for the purpose of computing the weighted average number of ordinary shares, these shares are also weighted on time basis. They will be multiplied with the proportion of time they were held during that year. And then from there, we can talk of the shares issued as a result of exercise, as a result of exercise of a share or stock option. Share or a stock option. So first of all, what is a share or a stock option? So basically, these are privilege which is given to the employees of the company to buy the company shares upon meeting certain conditions which have been set by the company at a price below the market price. For example, as an employee of the company, you can be given a privilege, you can be given a right to do what? To buy the shares of the company at a price below the market price if you work with the company for a certain minimum number of what? Of years. And therefore here, once the employees exercise that stock option, they'll be buying the shares of the company at a price below the market what? A price. And therefore, those shares which will be issued by the company, once the employees exercise this stock option, these shares we split them into two components for the purpose of computing the weighted average number of ordinary shares. Number one, we compute the shares which are issued at full market price. And then number two, we compute the bonus element. Bonus element in this case are the shares which are issued free of charge. So to compute the bonus issue or the shares which are issued at full market price, number one, we compute the amount received by the company. Amount received by the company. How much amount did the company receive from the employees once they bought the company shares? Then we divide that with the what? We divide that with the average market price. Divide that with the average market price per share during that particular financial year. So this will give us the shares issued at full market price. And basically these particular shares always, they are supposed to be weighted on time basis. They will be multiplied with the proportion of time they were held during that year. And then from there, compute the bonus element. Bonus element, basically these are shares deemed to be issued free of charge. So to compute this, number one, we determine, or basically we take total shares which were issued, total shares which were issued by the company. And then to this, what do? We less issue or the shares issued at full market price. So this will give us the bonus element. The bonus element, the shares issued free of charge. And actually this bonus element, this one will be treated as an equivalent of shares issued free of charge. Number one, these particular shares, they are not supposed to be weighted on time basis during the current year. when computing the one-offs. And number two, we also use them to restate the earnings per share for the previous financial year. So therefore, this is basically how we deal with what you refer as a stock option, or basically a share option, a stock or a share option. So the last cause of the change in the number of shares issued during the current year is what we refer to as the right issue. Right issue. What is the right issue? Right issue basically is the issue of additional shares to the existing shareholders of the company at a discounted price to the market price. At a discounted price to the market price. In other terms, this is the issue of additional shares to the existing shareholders of the company at a price which is below the market price. If the shares of the company are trading in the securities exchange market at a market price of maybe shillings 40, the company may decide to issue additional shares to the existing shareholders of the company at a price of 30. So, and basically, which is known as the exercise price. Exercise price. So this is a right issue. It is the issue of additional shares to the existing shareholders of the company at a price or at a discounted price to the market price. Equally, once the company makes a right issue, it is assumed that some of the shares have been issued at full market price, whereas other shares are treated free of charge. And therefore, a right issue is basically treated almost the same with a stock option. So therefore, the shares issued by the company during the rights issue are split into two. Number one, issue at a full market price. And number two, what we refer as the bonus element. Bonus element, we are referring to the shares issued free of charge. So in terms of how we compute this, we do that split is almost the same with the stock option, but with a slight difference, because like here, when computing the shares issued at full market price, first of all, we have to determine how much amount was received from the existing shareholders of the company once they exercised the right, they bought the shares. And then we divide this with something called the theoretical ex-right price. Theoretical ex-right price, this is the expected market price per share after the right issue. This is the price at which the shares of the company are expected to be trading at in the securities exchange market after the right issue. Usually the examiner will not have given you this, and actually we're going to look on how we determine the same, we compute the same. And then it is also important to note that these particular shares, because they have been issued at full market price, they must be weighted on time basis. And then from there, we compute the bonus element by taking total shares which were issued, issued by the company during the right issue, minus issue at full market price. And this bonus element, number one, is that those shares are not supposed to be weighted on time basis during the current year. And number two is that we also use them to restate the earnings per share of the previous financial year. So therefore, this is basically how we deal with what you refer as the right issue. And remember, in this case, there is something I've mentioned here, which is known as the theoretical ex-right price. And actually, theoretical ex-right price, we have said that this is expected market price per share after the right issue. Usually, this is something which the examiner will not have given you. And actually, this one you have to compute it. And this is one of the area whereby the examiner is equally try to cut you, because if they not give you this, majority of the students always do have a problem as far as the computation of this is concerned. But to compute this, there is a very simple approach which we can use here. So what you do is that you can take, you just take the shares, because in most of the cases you'll be told, for example, during the right issue, the company was to issue like one share for every 4 shares which were held. And in this case, we can be told this one share which will be issued during the right issue will be issued at a price of 30. And then these 4 shares which were held before the right issue, each share had a market price of 40 bob. So to compute the theoretical ex-right price, what you do, you take the number of shares which were held before the right issue. Like in this case, we are told if you held 4 shares before the right issue, and each share we know was trading at 40, then during the right issue, as a shareholder of this company, you are to be issued with 1 share at a price of 30. So therefore, to compute the theoretical ex-right price, multiply this with this, which will give us 160. This times this, which will give us 30. You get a total here of 190. And then you take the total number of shares which will be holding as a shareholder, so which will be 5. So to compute the theoretical ex-right price, you take the total market price of 5 shares, divide that with 5, so that now you get the theoretical ex-right what? Price. So whatever you get here is now what is known as theoretical ex-right price, and basically that is what you use here in splitting those particular shares issued by the company during the right issue into those 2 components, the issued full market price and the bonus element. So therefore, basically that or these are some of the causes of the change in the number of shares which were issued in course of the year. And basically that brings us to the end of that session. So once we come back in our next session, we're going to look on an illustration regarding the computation of basic earnings per share. So see you in the next session.